Guys and girls, welcome back to another Beaumont Outlook's fundamental educational video. Today we are going to discuss cost push versus demand pull inflation. Now, what is cost push versus demand pull? Both are types of inflation, but their origin and causes are binary opposites. Cost push inflation and demand pull inflation are two primary types of inflation, each with distinct causes and effects on the economy. Understanding these types of inflation is crucial for analyzing economic conditions and health and making informed decisions in various sectors, including policymaking, investment, and business strategy. Now, what's cost push inflation? Cost push inflation occurs when the overall price levels in an economy rise due to increases in the costs of wages and raw materials. It is essentially inflation caused by a decrease in supply, the total supply of goods and services produced in the economy, and also it is a byproduct of businesses pushing costs onto consumers. So let's look at the causes. Increased production costs. This can include higher costs for raw materials such as oil or metals, and increased labor costs due to wage rises. Supply shocks can cause natural disasters, geopolitical tensions, or other events that disrupt supply chains, and this can lead to shortages. Regulations and taxes. Increased regulatory burdens or taxes on businesses can also increase production, leading to higher prices for consumers. Now, all of this leads to one thing. If there is increased production costs, if there is supply shocks, if there is a change to regulations and taxes, businesses, instead of soaking this up and taking the hit on their profits, they cost push this onto consumers. Now, the effects of this is simple. Reduce supply. As it becomes more expensive to produce goods and services, companies may reduce their output, and this, of course, rises the price. Higher prices, because, of course, to maintain profit margins, businesses often pass the increased costs onto consumers via higher prices. And finally, potential wage price spiral. Rising prices can lead to demand for higher wages, which in turn can lead to further production cost increases. Now, the opposite to cost push is demand pull. Demand pull inflation occurs when the demand for goods and services in an economy exceeds the supply, leading to an increase in the overall price levels. It is essentially inflation caused by an increase in aggregate demand. Now, the causes for this are increased in consumer spending due to more confidence, more disposable income, and lower interest rates can encourage borrowing. Government spending can play a role into this. If significant government expenditure on infrastructure, defense, or social programs lead to injecting money into the economy, this will, of course, boost demand. And finally, expansionary monetary policy. Lower interest rates encourage more borrowing, and of course, that means more spending. And this will, of course, increase the overall investment into the economy, and thus demand will pull price higher inside of that economy. Now, higher prices will be, as a byproduct of this, demand will outstrip supply and prices rise. Increased production in response to higher demand. Companies may, of course, produce more, leading to more growth. But there is a risk to this as the economy may potentially overheat. If the economy grows too quickly, it can lead to prices overheating, where demand far exceeds the economy's capacity to produce and supply. And of course, demand outweighs supply, resulting in sustained inflation. Now, let's look at interest rates, health of the economy, and currency valuation when comparing these. Both types of inflation can lead to central banks to adjust interest rates. However, the response from market participants may be more, let's just say, immediate and pronounced with demand pull inflation. Central banks seek to control an overheating economy. A good way to look at it is cost push isn't due to large amounts of consumption, large amounts of spending, whereas demand pull is. So an economy that has demand pull inflation can handle higher interest rates because people are earning more, they're spending more. Whereas if you raise rates in a cost push inflated environment, there's risk to this as it's not, in essence, demand led. Currency valuations, of course, inflation can affect a country's currency valuation in the FX market. High inflation relative to other countries can weaken a currency because it erodes purchasing power. The central bank's response, particularly in terms of interest rates, can also influence the strength. Higher interest rates to combat inflation can attract foreign capital, strengthen the currency. And now, of course, lower interest rates does the opposite. And finally, economic health. Persistent cost push inflation can signal structural problems in the economy, such as inefficiencies in production or labor, while demand pull inflation is often associated with a strong economy. So that is us, guys and girls, on cost push versus demand pull. In summary, understanding the difference between these two is essential for economic analysis and decision making. Each type of inflation has distinct causes, effects, and implications for policy, the economy, and the FX market. Thank you for tuning in and have a wonderful day. Let's jump straight into the next video.